let's get started. So Trump, another 4 years of Trump. Who would have thunk it? Overnight, I sort of watched the election as things were progressing, and it really from the exit polls came in about 11 p.m. in Europe. And as soon as those exit polls come in, and the US exit polls are a little bit different from what we're used to in Europe. In Europe and the UK, we're used to a sort of who are you going to vote for type questions. They would in the US, I know they are different. It's more what matters to you, what are the themes that matter to you, and the themes that were coming out last night in those exit polls were the economy, they were democracy. At the time, that could well have been directed at either candidate, but it did seem from the get-go currencies were moving in the direction of a Trump victory, equities were moving in the direction of a Trump victory through futures markets. And there didn't seem like at any point during the night that Harris was ahead. It was about 4 a.m. European time when it looked obvious to me that Trump was going to win, and I think it was called soon after. We looked at this yesterday, pre-election, and I sent it around, and this was Goldman's traders' view of what markets may do in the event of the 4 different outcomes. I've just shown the first 2 here because these are the only 2 likely ones at this point in time. The market does appear to be pricing more the Republican sweep outcome than the divided government outcome, and we'll see a little bit later that the Republicans have taken the Senate and they flipped a few seats there, and they are looking like they are moving towards taking the House. The prediction markets are heavily in favor of that happening, but in reality, it may well take a day or 2, or perhaps even more, to get all those votes counted. But yeah, as we can see, we'll see a little bit later, S&P up in the region of 3%. We will see financials outperform cyclicals over exporters. It's certainly the case, at least in the futures markets and the pre-market. I know the market has just opened. That Russell is massively outperforming Nasdaq. Things like Nvidia, Microsoft, those type of stocks are flat, and I probably expect them to go lower today, and we'll touch on that in a little bit why. But yeah, this does appear to be the outcome that markets are currently trading towards and currently pricing. In terms of how things developed last night, very quickly, well, this is where we are. We'll say Russell is up in the region of 6%. The dollar complex broadly up in the range of 1 to 2% against emerging market currencies, the yen, the Chinese renminbi, and S&P futures are also up in the region of 2%. But the big outperformer on the day is our small caps. We noted that previously in a few calls that was the outcome is likely to be positive for small caps regardless of the incumbents, albeit with potentially quite a bit of volatility at the start. The perception is that for a lot of those smaller companies, the deregulation, the tax cuts, the corporate tax cuts will outweigh the impact of tariffs. Not all of them are exposed to tariffs. At the very end, I'll show you a basket that Goldman's put together that has a list of companies they think are tariff exposed or not. We won't go through it right away, but the one danger for Russell is this gold line, that is the 10-year treasuries. If that goes up in the region of sort of above this chart, but in the region of 4.6%, that's a level where the risk takers, the rates traders at Goldman's have been calling it might get a little bit hairy for small caps, but the level of small cap outperformance and market outperformance suggests at the moment the market is trading the red sweep outcome. 2 lines on this chart. This is that's what I was talking about when the polls closed. Obviously, I've normalized the chart, so it's always going to expand away from there. But just making the point that between the polls closing and about 6 a.m. European time, the trend was already pretty much in play. The dollar had done most of the heavy lifting already, and indeed it's been largely sideways since then. The Mexican peso had weakened significantly. Treasury rates were up. But it took I imagine that Trump winning Georgia and Pennsylvania to really accelerate the small cap futures. They really started just at this point. I haven't put VIX on the chart, but if we did put VIX on the chart, it looked like that. So that sort of 6 a.m. point European time was when everything got going and perhaps started to price the red sweep, and that just continues as we speak, with no doubt with plenty of volatility to come. But the outlook does look very positive. That's the result, and he continues to win more votes. I think is projected to win more. Quite a spectacular shift. This is the red bars are showing the shift in the different counties towards Trump or towards the Democrats, and it's a pretty spectacular move in Trump's favor. Polls were wrong again. The prediction markets were right. This is how he won, and this is my point. Which if we look at the odds of a Trump victory, at no point it seemed just to be a steady increase in probability for Trump winning and Harris not winning. So there was no sort of Democrat ahead and back and forth sort of thing that we often see. And I guess that was a sign that it was likely to be a bit of a landslide. And you can see in the most competitive states, well, they've either won in Georgia, extremely tight in Wisconsin. I think when Wisconsin clears, that's when it was officially called. But Pennsylvania being very important for Trump to win, or at least to deny Harris winning. But yeah, you can see in those most competitive states, either ahead as we're speaking, or when I took this snapshot earlier, or they'd already won. So they basically won all of the swing states. Again, just emphasizing just how broad-based the move towards Trump was. The Republicans have taken the Senate, so they've already surpassed the 50 votes they need for the Senate, the 50 seats, and they flipped 3 from the Democrats. They may well end up with more than that. It may well be more now since there's been some more counts. So Republican control of the Senate. The House is still up for grabs, albeit the Republicans are ahead, but there's still a lot of counties to report in California, in Arizona, in Nevada, and these places, and that could drag on for a day or two. I don't expect this to be called today, albeit, as I say, the markets seem to be leaning towards a red sweep. And if we look at, oops, I don't have that chart. But if you look at if you go to the Wall Street Journal, the New York Times, whatever this is from, I think it's from the New York Times, you'll see that in the key sort of swing states, if you like, for the House, so the states where it's pretty much narrowly expected Republicans to win or to be 50-50, the Republicans seem to be ahead. So we won't know whether or not it is a red sweep for a while, but it's certainly looking like that, and that is to some extent what markets are pricing. That's just a rehashing of what I've just said, essentially, that the House is leaning towards a narrow Republican majority. Just how narrow it is, of course, will matter in terms of what they can get through in terms of legislation, but it is certainly moving in that direction. In terms of policy, what's going to happen with Trump? We know there's sort of 3 main areas we're pretty clear on. His tax cuts that he enacted back in 2017 roll off next year, so one would expect they will be extended, and potentially some more modest tax cuts. Increase in federal spending and tariffs. Absolutely, tariffs are key, particularly on China, possibly 20%. To the extent of Republicans controlling the House, the bigger the majority, I expect the bigger the tariffs. And there's also going to be auto tariffs focused on Europe. So the big losers today, China and Europe, and inflation to some extent. Yeah, and that may create a slight drag on GDP. Immigration, I think we're all aware of what he's been talking about with immigration. That's likely to be more emphasized if it is a red sweep, and of course, a rollback of regulation in energy, financial, and labor sectors. That's one reason why we are anticipating, or we are seeing, a big jump in financials, and indeed, we'll see a little bit later, Goldman's reporting early flow, looking like rotation into some of those sectors. It's sort of early market flows, market reactions, nothing surprisingly there, very dollar positive. Yeah, the hedge funds selling euro, and so on and so forth. The Chinese currency perhaps has dropped less than expected, largely because the Chinese central bank are managing it. A bit of a mixed picture in Asia with the Nikkei benefiting from a weaker yen, but the Hang Seng falling on tariff concerns, and just broadly across the dollar complex, aside from a broad dollar strength. Bitcoin, as I'm sure many of you be aware because you follow it or you own it, Bitcoin is up substantially. Trump considered considered Trump friendly. Well, I think it's more that Trump is considered Bitcoin friendly. You know where that came from. That's ChatGPT for you. Russell at the time was up 3.5, but that's gone up even more, and that's largely, as I say, because small caps are seen to benefit the most from tax cuts and deregulation, and VIX has been crushed as we expected as the event risk moves past. Inflation expectations are up, interest rates are up, less interest rate cuts priced from the Fed, and it's going to be really interesting to hear what Powell has to say about that on Thursday. Oil down, that's maybe surprises some that oil is down, but it's seen to be linked to the potential for increased supply and Trump's drill baby drill comment and a stronger USD, so the potential for the US to produce more oil, although we'll wait and see on that one. Gold and silver are both down. We flagged the risks for both metals into the election a few days ago. Goldman's themselves flagged the fact that positioning was extremely long in gold, and it may well sell off post-election. Longer term, they are still very positive gold. I'm still very positive gold into next year, largely because of this, because of the potential for inflation. But right now, right now gold is down, but silver is down quite a bit more, just as the dollar is stronger. Yields are higher, a stronger dollar, higher yields. For some, it means it's more attractive to hold something that's yielding than gold. So over time, we'd expect that impact to fade as all of the drivers that we talked about for gold are still intact, and indeed perhaps even accentuated if you think that Trump in the White House is going to be a bit more unpredictable, and the dollar will continue higher. That may accelerate the de-dollarization that we've seen coming from the BRICS, and part of that de-dollarization is moving assets into gold. It's seen as safer for some of those central banks to hold gold, but just at the moment, as was expecting, gold and silver are struggling. Remember, we've got jobless claims tomorrow, and we've got the FOMC meeting, so things just keep on coming. I won't dwell too long on this, but yeah, just a little suggestion that election day moves don't always last. They certainly did in 2020 and 2016, but prior to that, it was often the case that election day moves were reversed. I don't think that's going to be the case this time around, for a few reasons that we go into, some technical reasons, um, and also just a red sweep and the fact that the market was underowned into this. But these are the sort of key setups, the key themes. So going into it, traders went into the event pretty, and I mean institutional traders, so hedge funds and the like, were pretty light on risk. It's a very strong technical setup in terms of year-end seasonalities, and one would expect to push towards pro-cyclical stocks, reflation trades. So that's not necessarily bad for tech, but it wouldn't favor tech into the end of the year. The themes are more stronger USD, bullish cyclical, domestic cyclical US equities, small caps and the like, and higher rates. And I said pretty strong seasonal tailwinds coming from strong support from corporate buybacks, from what pension funds tend to do, target date funds tend to do around about this time, but we'll cover the seasonality a little bit more in a bit. In terms of asset classes, just re-emphasizing what we talked of, VIX has collapsed. Japan is doing well, the dollar is doing well, inflation is moving higher, oil down on supply concerns, gold is down as we talked about, but positive medium term, but pretty mixed short term. And just one level to watch is 4.6, in the region of 4.6 on the US 10-year yield. Right now it's at 4.47, so we're not there yet, but just keep an eye on that. That's linked to the view that if interest rates move sharply higher, it will, one, likely price out, continue to reduce the expected interest rate cuts that are coming from the Fed, and two, it makes life a lot more difficult for small caps. We've been talking for a while about why into the end of the year you may get an equity melt up, and seasonally things are very positive. There's a bit more than that behind it, than just seasonals. There's sort of market internals post the event now, given the results, will swing very positive. Market makers are likely to have to buy a considerable amount of delta. Part of that is because people were very well hedged going into the event. The put call ratio you can see there, puts trading massively over calls. That's all going to be unwound. And remember, when a market maker sells a put to you, they hedge themselves by selling futures and other things, because if they sell a put to you, it's like you doing a bear put spread. They get long. So all of this flow for big institutional clients and pension funds to protect themselves to buy puts would have been hedged by market makers selling US equity futures. Now, if a client comes back to close out those puts, or they're worthless, or as we'll see, the delta has dropped on them, market makers need to go into the market and buy back those short futures. So no doubt that's happening as we speak. There's a couple of other sort of things that go on in the market that drive buying and selling from systematic funds. We have these, a big player in the US market is these vol target funds. They try to target a constant level of volatility. So what that translates to is that when markets are more volatile, they reduce their risk, and they do that by selling equities. And this is just their equity exposure level here. And you can see that big drop that occurred into July, into August, and it's since been building up. But as that volatility drops out of the series, they will have to buy more. Risk parity funds, they basically try to keep the same amount of risk and everything. So they buy some bonds, they buy some equities. But again, their positioning is very light on equities. You can see it's much lower than it was earlier in the year. So they may well have to buy as well. And they are pretty big in the US. The other thing that can drive buying flow, I'm sure you're perhaps more familiar with, is the buybacks. November is the strongest month of the year, and November, December are the two strongest periods of the year and these are significant numbers, right? It's not 1,200, that's 1.2 trillion. So these are very big numbers, and they've just been going up year on year, and the expectation is they go up next year. I think I had a stat in my presentation yesterday that year to date, Apple has spent over 100 billion buying its own shares back. So year to date, Apple effectively bought Intel's market cap in its own shares. So let that sink in for a bit. More sort of from Goldman's, they saw institutional portfolios degrossing, just another word for reducing exposure into election night, and that is down to one of the lowest levels since March 2023. So the expectation is those guys will chase the rally higher and look to lever back up again into year end. The seasonal stuff that we talked about, part of it is because these target date funds, asset allocation funds will be rebalancing now. They don't want to try and buy equities right at the end of the year when liquidity is poor, so they will start buying now. And again, you can see seasonally going back to all the way back to 1928. Historically, on average, the S&P goes up from here, and on average, it goes up more in election years. And remember, an average can hide many sins, but that is the average. Nasdaq tends to do a little bit better, although interestingly, in election years, it tends not to do all that well. And I wonder if we will see something like that now, as there's a bit of rotation. The one where there is a lot of expectation, and unsurprisingly, because it's already gone up a lot, and this is Goldman saying they've got a lot of questions on it already. The Russell post-election tends to go up almost 8%. So again, it's well on the course to doing that. That's the Russell. I posted this gamma chart yesterday, just for those that need a refresher. Gamma is, when we talk about long or short gamma, it's really talking about what is a market maker in a very broad sense of the word. What's a market maker doing to hedge his position? If the market goes up and a market maker is long gamma, they're typically selling futures. If the market goes down and the long gamma, they're buying. It's kind of where we've been for most of the year, albeit we had a few forays into short gamma when we had those big sell-offs in July and August. And when a market maker is in this sort of region, perhaps obvious that he's acting to reduce volatility. So if the S&P is selling off, he needs to buy more futures, or she needs to buy more futures, and vice versa. But where we are right now, because of the last option expiry, is we are pretty much zero. So market makers right now having no impact on the markets, and they could even get short gamma here, which means that they could accentuate any moves. So right now there is no long gamma overhang, and that leaves us open to move a lot more in either direction, but the direction of least resistance seems to be up, and that's the reminder. The average was 4.7 billion long. That was muting market moves recently. That is gone. So another reason to be cheerful if you're bullish. I won't dwell too long on this. It's a little bit technical, but for those of you that I think Mihai's on the call, Mihai, you'll like this chart. This is just showing you that as volatility drops, the delta on a 95% option also falls, and the read through of this is that market makers are short a lot of these put options, and therefore as the delta falls, they need to buy back more of that short delta. So again, a market maker sells you a put, they get long exposure to the market. The higher the delta on that put, the more they need to sell that position. The longer they are, the lower the delta is, the more they need to buy. So as volatility drops, that Vanna effect is what we call it. The sensitivity of delta to volatility, that Vanna effect forces dealers to buy more of the underlying, and that's just a really, it's a geeky chart, but it's a cool chart. I like it. I'm a bit geeky like that, but
I like it too.
I know you'd like it too, Mihai. um,
So
and
that's a new Greek that I have not heard before,
you
right?
Greek, yeah,
Vana.
yeah,
It's a second derivative, right?
yeah,
Of
yeah. It's a
the
second order one. Yeah, the sensitivity of a sensitivity.
of
It is good.
of
You know,
yes. So
with
it's
that,
delta to volatility, right? So
yeah,
the
yeah.
first derivative is to price, that gives delta, and second one is to volatility, that
Yeah,
gives Vana.
but it is, you know, it isn't completely irrelevant to you guys, because you probably won't notice it, but the impact of volatility being higher recently has meant that your 25 delta strike has been physically further away. So that again, as vol goes up, delta for a fixed percentage out of the money goes up, and therefore the point at which the option is 20 delta is going to be further above or below the market. So that's one reason why selling um, trading credit spreads, if vol is high and falling is advantageous for us. It's not necessarily we get paid more. It's we get paid a little bit more, but because we're doing a spread, we don't necessarily get paid all that much more. It's more that we're selling a strike that is further away than
Farther out. Yes.
further out, and therefore it's safer, and therefore there's more chance that we don't get stopped out. And two, if we manage to um, just call it at a nice point and we sell it and vol drops, we get a quick windfall from the price of that option dropping. So that's Vanna at play. You probably might not have heard it described as that before, but the reason that we like to sell higher volatility options, and if we think vol is falling, is largely due to Vanna. And this is just kind of reiterating that this is the volatility of the S&P at all the different expiration dates into the future, and we can see that for the 5th of November and the 6th and the 7th, vol was exceptionally high compared to where it is in December. And that just means that because of that, and that's likely because there was high demand for puts. So this is what market makers' position was like this morning. Short puts, which equals short stop futures. No event, vol drops, dealers have to unwind hedges and buy back their futures hedges. And that is what they will have been scrambling to do all morning. No doubt woken up quite early to do that. This is just a recap of the more traditional buyback flow. Again, big.
Well, a question about these futures and dealers getting up early, they basically are selling them to overseas buyers, right? They would
The market
they are
makers, futures market is super deep in liquids. They'll be selling them to algos, selling them to whoever else is the liquidity provider, or buying them rather. They're not selling futures; they're buying futures. So yeah, I mean it's there will be market making machines that are trading against them, and in some
but
cases.
when you say getting up early, you are talking about the New York time zone, right?
Yeah, I mean, just making the point that the futures trade 24/5, right? So once the outcome was looking likely and vol was dropping, then somebody is starting to hedge those positions. So it's not the case that they wait until the market opens, right? At 3:30 in the afternoon to go and hedge the positions. They will have been doing it all night. The big banks they have what's called a global book, so they move the book around the world to some extent. So when the New York guy is asleep, guys in Tokyo or Hong Kong, there will be somebody there who would be able to hedge his book. So at times they hand these books around. Goldman's, I know Goldman's also do a lot of delta hedging via AI. So they have computers doing it. And that was 3-4 years ago. So who knows what they're doing now? But yeah, that's definitely, that flow will have been ongoing. I'm just making the point. It's not that that's something that's going to come this afternoon. It will have been ongoing all through the night. And one of the reasons why SPY is up and Russell is up substantially. But this is to come, and this is just Goldman's. This is what they see on their desk, and Goldman's obviously are one of the bigger counterparts. So yeah, 960 billion worth of buybacks in 2024, and about 100 billion coming in November, which translates to about 6 billion a day in the 19 trading days in November. Because remember, November has got Thanksgiving and vacations at the end of it, so it's a bit of a shorter month. So yeah, a net potential 6 billion being bought back every day for the rest of the month.
What is VWAP? What is VWAP?
VWAP is a volume weighted average price volume.
I see.
Basically, just VWAP. A VWAP. You know, if I wanted to sell $1 billion of S&P, I'm not going to just go and sell it like that. I'm going to string it out over the day, and I might do a TWAP, which is just to say, I've got 600 million to sell, and I've got 6 hours. I'll do, 100 million an hour kind of thing. I'll just do it time wise. VWAP is focusing on volumes. The instruction you would give to your dealer to pass on to the trader is to say, I want to be no more than 20% of the volume in the futures market. So it's all about not having market impact, and VWAP is the norm rather than TWAP for different reasons, but maybe for obvious reasons. When there's more volume coming through the market, you can be a bigger part of it. You can sell more than if there is less. But yeah, that's just what VWAP is. These orders do not go through as chunks. They get sort of spread out over days and weeks. Okay. People have been asking what's going to outperform now that we've got Republican possible red sweep. Financials for sure, and that's already happening. Potentially construction companies, onshore energy producers, coal, steel production, they should all outperform. Goldman seem to think law enforcement, domestic security, can't think why that would be. But companies that have, companies that are sort of linked into those sort of cyclical US companies, and of course, crypto and Bitcoin. If you want to know what will do well in a Republican in a red sweep, just look at what's up today, I would say, because that's what's going to do well, what is already doing well. This is what Goldman's are reporting was happening sort of early on in their single stock book. So they're seeing hedge funds come in to buy banks. They're seeing healthcare. So hedge fund demand for healthcare stocks. Interesting in tech, they're seeing demand for cyclicals, so semiconductors, and this sort of anticipates sort of source of funds trading in megas early. Just wonderful trader jargon. What they're basically saying is they're expecting a rotation out of the likes of Amazon, Apple, Meta, possibly into the semiconductors. And they are currently, when they wrote this, they were all red, and some of those stocks are struggling a little bit in China, and again in the ETF space, XLF, Russell, and two ways of biotech. So I don't think any surprises there, but for those that are interested, that's what is currently happening in terms of what the big hedge funds and the institutional players are doing. I'll probably finish there. I've got more on tariffs if people want to see it later, but I think, we won't go through tariffs too much. This might be of interest to people. I can share the presentation, but Goldman's put together these tariff baskets. So this is companies that are at risk of tariffs and companies that are not. Of course, not all of these will be optional. Lulu, I know is. Maybe some of these other guys, Target, Nike, Gap, Ralph Lauren, I don't know, Under Armour. But yeah, maybe give you some ideas for um, potential shorts, or maybe explain why some things are underperforming and these ones are not necessarily exposed. And the one of the rationales for coming up with this is just looking at how tariffs are going to impact. Why are tariffs going to impact? Well, it's trade policy uncertainty, the net trade effects, and they estimate about a 1% GDP hit in Europe. China, Japan, and Germany most heavily impacted because of their manufacturing share of GDP. So it's not a great result for Europe. Europe is underperforming at the moment. Just as an example, that's Maersk, a big shipping company, underperforming just due to the potential disruption of trades in terms of what will be the impact in Europe. Goldman's are going potentially 10% drop in the euro and a similar drop in the renminbi. How does that all impact what the Fed is going to do? Well, so far the market has been shifting, kind of continuing to shift the distribution to the left. So if you kind of draw two distributions there, this is what we looked like a month ago, with the most probable place for rates to be at the end of the year, somewhere in the range of 325 to 350. That's shifted up about 50 basis points. So part of that is just the better data that we saw through the month, but it's also, you can see the 1 day impact has been the difference between that bar and that bar, and that one and that one and that one. So they've gone down and they've gone up. So about a maybe one rate cut been priced out by today. Not enough to concern the market. We're still pretty much on course for 25 bips in November and 25 in December. But and therefore there's no event risk over the actual interest rate announcement from the Fed tomorrow night, where everybody is going to be tuning in and hanging on Powell's every word is the press conference, and they're really going to be, I expect, drilling him on questions around what are you going to do if inflation goes back up again next year. You've only managed to cut 75 basis points. How can you possibly cut interest rates if inflation is going higher? What's going to happen to the Fed's independence? What's Trump going to do about that? So he'll have a lot of difficult questions to answer, I expect, tomorrow night in the Q&A, and it'll be fascinating to see how he feels that, and that might be a short-term, near-term banana skin for markets.